Alrighty, welcome everybody. So it is Thursday, September 25th, 2025. Live trading with Income Navigator here today. So we're going to spend, like I said, the majority of the session, we're going to talk about leaps and how to get into leaps at this point in time, especially with the markets. Well, we're at all-time highs. I mean, we're only a 0.5% down today, but not even that much. But we're going to talk about how to scale into to leaps in an investing portfolio, or if you simply want to use them for other things like poor man's covered calls, the income poor man covered calls, or just again buying leaps just to own them. So we're going to spend some time on that today. That'll be the focus of it. Before we do that, we're going to jump in. We'll give a quick overview of the markets, and then let's jump in. So that being said, we got lots of things to do today. Let's get into looking at some of the screens. Let me get off of the screen here. There we go. All righty. Let's jump in and do the best with my voice that we can. So here's the S&P today. Like I said, we are down not even 0.4% now. We're down only 28 points on the session. We were down a little bit more earlier. We're definitely off of our lows on the day, which is all good. Today, no real big no real big anything. I mean, everything's still in a solid uptrend. We're still hanging around right around this 8 EMA, which is really pretty far. If you go back and look, we're rarely this far away from the 21. So a pullback absolutely is a great thing. I think if you want to get into some trades, I don't know that today's the day to necessarily do that. Maybe there's some more downside to go, or maybe today was it, and that's is all we get, and we go higher. Uh, but things are still in great shape. The 8's above the 21, the 21's above the 50. They're all rising. They're all moving away from each other. Things look pretty strong. I mean, you do have MACD rolling over. You have RSI dipping down, and the stochastic momentum overbought and starting to tip over. But that being said, not really a big deal. In here. Everything is still solidly bullish on the weekly charts, and I would want to see more of a pullback. Uh, Again, some of you may or may not like the pullback, but I think it's really needed in the market here. I would expect maybe a little bit more, but we've already had a pretty significant reversal on the session. So this is good. If you were not able to get into maybe the 112 trade yesterday, today might be a good day to do that. Doesn't mean, we're going lower or higher, but it's a better opening today if you didn't get in. All right, quickly, looking at oil. Oil's just off its highs on the day today. Still looks decent, off of its lows. It had sold off earlier quite a bit more. It's still down. I think it's still a really decent strangle opportunity in here. And I think it's still a really decent 112 opportunity. I think it's actually a better opportunity today than it was yesterday. So I like where we are on oil. I think both strangle 112. And because you would do a strangle and a 112, that means also a jade lizard is not a bad trade on oil. All right. That being said, let's just jump into gold. Gold just off a little bit on the session today with everything else. We're now down only 26 points on the day, 25 something on the day, so under 0.4%. So again, the more I'm talking here, the more we're recovering. But gold just pulling off, still very strong. 8 above the 21, above the 50, above the 100. Everything stacked, everything increasing. Any pullbacks, I think, are opportunities to buy the dip on any of these, ES or gold. And then bonds. Yeah, bonds are dropping, breaking below this little pivot support area here. I don't think we're going back to, all-time lows or anything in bonds. It's just going to keep up and down. The 8 is still above the 21, it's still above the 50, it's above the 200. That being said, the 8 is, rapidly approaching the 21 here. We're below the 21. We have a bearish PSR, so we are still bearish in bonds, just like we are bearish overall in oil. But oil now just give us a little bit more of a bullish signal. So we've been bearish. We now have a higher high in oil. We now have a bullish PSAR. We are now 8 above the 21, stock above the 21, and RSI above 55. So oil is now bullish. Okay, so had been bearish, turning a little bit more bullish now. And then you've got bonds, which had been a bit bullish, but they're bearish at this point in time. We've dropped below the 50. We've dropped below the 21. We have a bearish PSAR on bonds. I don't think that means things are going, to zero or anything here. I just think it's a continuing really, really good strangle setup. And I'll watch this a little bit more, but I think if we get any more weakness here in bonds, or we get close to this 50 uh, or 200, anywhere in this range, right around the 115 area, then I think I will be selling some naked puts as well. I would like to see um, on bonds that we get a little bit of an IV bump. VIX is not doing anything today. It's up, 43 whole cents, which means there's absolutely no panic in the market. Now we're down only 24 bucks. There's just no panic in the market. VIX is not elevated at all. It's, if you look at the weekly chart here, it's as low as it's been almost this entire more than a year now. So we're still way below all the averages. No, uh, no fear, no anything in the market so far. All right. That being said, you got some decent moves in some of the stocks. Amazon, not one of them, but this is a pretty good sign on Amazon. A pretty nice reversal candlestick here, where we had sold lower, we're higher. Uh, on the not on the day necessarily, we're down 3 cents, but we're certainly well off of our lows. Nice looking reversal candle right at the bottom of the Bollinger Band and right at the 100-day moving average. I think if Amazon's something you like, and we're going to talk about leaps in just a minute, then this would be one to potentially consider. And I know Amazon's going to show up on our screener. Nvidia. Uh, Up on the day today, 2 decent days of selling. Uh, you know, I think Nvidia looks decent here. If you're looking at Tesla, it's had such a phenomenal run. It's down 3% today, but it's been up 5% in a day, down 5, up 5, whatever. It's just consolidating in here, really strong. It could use a bit of a pullback, in my opinion. Nothing I would do there. Meta. We did temporarily break the 618 fib today, hit the 50 and bounced off of it. I think this is not a bad spot in here either. Uh, Apple doing great. Google, nice pullback in Google, and then a big hammer candle today so far. That can change with the 8 above the 21, above the 50. I mean, this thing has been really, really strong. So any pullback here is certainly welcome. I'm just going to skip through here quickly. Palantir was down. Now it's up off of its lows, now, and up for the day about 2%. So we still haven't really gotten an opportunity in Palantir. This was the opportunity back here when we hit the 50, and then you had the 8 cross the 21. That was a great day to get in. Everything at that point, you had the 8 above the 21, above the 50. Those are perfect days, in my opinion, to get long on leaps. All right. Hood looking good. This was again the opportunity here. Came down, touched the 50 as soon as the 8 crossed the 21. To me, great day to get in. Okay. Netflix. Now, Netflix is just hanging right around all of its moving averages in here. I don't think this is a bad spot for Netflix either. So we'll see. And then Broadcom, I'm waiting for the potential entry points. I'd love this pullback. I think this is giving us a better entry opportunity. SoFi, seemingly indestructible, touched the 221 EMA today, bouncing off of that. I think this is not a bad spot for SoFi. And Uber, I love the the doji candle here today. Nice reversal. Tagged to 21 earlier. Now it's back above the 8. This thing is in pretty good shape. Really trying to break out of this ascending triangle. All right. And then Bitcoin struggling today. Bitcoin's down, but it really is down again right on the 618 fib. Exactly is where it is. I mean, broke below it temporarily, but that's exactly where it is today. We've been just fussing with this 618 fib on Bitcoin, which means IBIT also down. Potentially good opportunities here. Uh, Probably what's getting beat up the most is strategy. Strategy down here, bottom of the Bollinger Band. This thing's really struggling right now. So it's really flirting, trying to hold on to this 300 level. There's not a whole lot of supports in here, and not a lot of places to really put your put any supports or anything like that. I think you have to go down here to this 234 to find, a halfway decent support level. And if we threw some fibs on this thing, kind of mixed it up a little bit, but we were holding the 618 fib just really, really nicely here. I thought this was a great opportunity to potentially get in, and then it's flipped over, broken that 618. So the fib's kind of done. So we're really in no man's land here. There's not a whole lot to stop this thing falling until probably this 235, which would not be a great thing uh, for holders of that. MSTX is also going ex-dividend here. So it's down with MicroStrategy, and it's going to go ex-div today. Distribution, I believe, tomorrow. All right. That being said, and then BitMine, this is a great opportunity if you like the stock. If you take a look at its trajectory here a bit. This is pretty good area of finding. I mean, I don't know if this is exact, but close enough. Coming down to the 50. If you like Bitmine and you like Ethereum, which again is really selling off here right now, getting almost oversold below its 50. This is not a bad spot to start poking in. All right, that's enough on charts and things as we go. Let's get into our session today on leaps. And I just want to talk about leaps as a whole. Again, I'm not talking about poor man covered calls. I'm not talking about income poor man covered calls. None of that stuff. Although there's a little bit to it here, but this is very different. If you were looking for a standard poor man covered call, well, this would, to me, would again be the setup. But I'm talking today about just buying leaps and why and how we would do that. So let me get into that training with you here. And this is talking about leaps. And the goal here is, again, to give you a framework for building long-term wealth with leaps. And I like leaps. So I'm a fan of leaps. I'm a fan of options. I love options, and I love uh, the ability to leverage up. Now, with great power comes great responsibility. So if you're going to lever up using leaps, uh, when things are bullish, it's great. When it's not, then it's going to be even worse. So we'll talk about that as we go. So let's get into leaps and understanding leaps a bit here. All right. So leaps are call or can be put options, typically with an expiration date 12 months or more away. Most of you, I think, know that. We're going to typically look at contracts somewhere between 9 and 16 months on average. I rarely go out 2 years, but you can. And I think 2 years is when you have extraordinary opportunities. And I think when you look at charts, when we had that big sell-off in March and April for the year, I think, and now we're only down by less than 20 points on the session. So we could go green. I don't know by lunch, but lunch is a possibility depending on your lunchtime. Anyway, when we had that big sell-off here in March and then beginning of April, that was generational. Okay, that to me is when, hey, if you get an RSI down to 30 or below, in that range, then I think that's an opportunity when you're at the bottom of the 3 ATR, you're at the, you're nearing the 200-day moving average. That's when I think you look at like 2 years out, okay, as opposed to like a 1 year out leap. I mean, that's an opportunity that doesn't come that often, and I think you have to take advantage of it. All right. So really quickly, why we use them, and we'll talk a little bit more about that. But that whole 9 to 16 months is probably the sweet spot. But you can go more. I'll even put a plus in here. All right. So why do we use them? Uh, you can go deep into money, which means you can mimic stock ownership, and you're going to use a lot less capital, which is the key here. We want to use, that 70, 80 plus delta there, and that's going to give us a pretty good approximation of moving, one for one with the stock. I'm not going to talk about synthetic um, stock today. I'm just going to talk about leaps in general today and really just selling or buying the single 80 delta leap. We can do synthetics another day. But the same everything that I'm going to talk about here will apply. All right. Another nice thing about leaps is low theta decay. So leaps are going to decay way more slowly compared to short-term options. So you're going to lose a lot less value due to the passage of time. So you can hold these positions longer and not really have to worry about suffering a lot of time decay losses. They're also flexible. You can combine them with income strategies like a poor man's covered call as well, or the income poor man covered call. There's a lot of different things we can do. You can also trade these a little more short term. You can still buy them because, again, if you, let's say, you want to swing trade a stock, but you don't want to buy the options. You want, and I'm talking leaps as options, but let's say you wanted to, I don't want to sell puts. I just want to buy the stock. And there's sometimes where selling puts, there's not enough strikes, there's not enough liquidity, potentially in the short term, and it's sometimes better to buy a stock. Bull, I don't know that Bull's a great example of that, but it's not a bad example. ONDS, ONS. I like Ondas Holdings. It's a good company, but they don't have a ton of strikes available, and sometimes the spreads can be a little bit wider. So you may want to buy stock, especially since it's only a $7 option or a $7 asset. But if I bought the leap on it, I could I could really lever up decently, and that's where I want the leverage. So if ONS goes up $2, well, it's a $7. Let's just say it goes up $1. Okay, so $1 on $7.62. Okay, that's 13%. That'd be great. But what if you just bought the leap on it? And if you bought the leap, and I don't want to get too deep into some of this, but let's say we bought like the $7.50 leap, and I'm not really showing my screen. I guess if you want, I can. So instead of buying the stock at 764, again, if it goes up $1, you make 13%. But if I bought the leap here, and let's say I bought the leap for 385, well, this is the 75 delta leap right here. Okay? It goes up $1, which means I go up 75 cents, but 75 cents on 7.5, I'm sorry, on 385. Okay, so 75 cents on 385 cost, okay, is almost 20%. So if I bought the leap and I just wanted to buy ONS for a short-term trade, well, instead of buying the stock, okay, I could have bought the leap. And if I make $1, if you think ONS is going up, and ONS is a good company, okay, or that a lot of people seem to like, out there, and it's had a huge run from $2 all the way up to $7 since the beginning of August. Okay, so in 2 months, this has gone from $2 to $7. Okay. Imagine what would have happened, okay, if you had a $5 move in 2 months on $3.90. Okay. Okay. So, or on, it would have been even cheaper at that point in time because you would have been down, but you would have potentially doubled or tripled the money in that, even though it's already doubled in size, you would have probably tripled in size doing that. So anyway, there's all kinds of uses for leaps, and it's not just long-term investing. Okay, it's anytime you have strong conviction that something's going to be moving short term, leaps might be the opportunity. Okay, all right, and then capital efficiency here, owning 100 shares of SPY at 500. Okay, and I know SPY is, I wrote this a while ago, so this is older, but let's say it's 650 now. Okay, I will update this for you live here. All right, so if I buy 100 shares of SPY at 650, it's going to cost me $65,000. Okay, but if I bought a 2-year leap on SPY, uh, it's going to cost me probably, if I'm again around the 80 delta, 80, 90 delta, it's going to cost me about $175. Okay, and we'll put that in here, $175. Okay. Well, $175 is 17,000. Let's clean this up. 17,500. Okay. All right. So you can control the same exposure, and this is not exact. I'm just giving you some numbers in here, but instead of spending 65, I'm spending 17.5. Well, 65 divided by the 17.5 is almost 3.7. Okay, so I control the same amount for a fraction. Actually, in this case, it's almost 1/3. Okay. So it's actually less than that. So it's almost a quarter. So 1/3 to a quarter of the capital, which means doesn't mean size up. What it means is you've got more money available for other trades and diversification. All right, and then last thing here, leverage. With stock, every $1 move in price is a $1 gain or loss. With leaps, a $1 move again can be 3 to 4%. Again, you're looking at this one up here. Instead of $65, I spent 17.5. That's a 3.7x return. Okay. 3.7x return on SPY. And for every 1% move, I'm going to make 3.7%. Okay. Due to it being, again, 1/3 to 1/4 of the cost of the stock. And again, don't forget, it also works in reverse. So on a day like today, well, I mean, the market's only down 20 points, but if the market moves significantly, 10, well, even today we're down 0.3%. Well, the market might be down 0.3%, but you might be down a full percent. Yeah. And the reason for that is you have leaps. Okay. So instead of losing, $1,000, you might be losing $4,000, today. All right. So, and it's about right for me. So I'm down today on 0.3% in the market. Well, I'm down about $4,000 because I'm down about a full percent. Why? Because I have leverage. Okay. And so leverage works both ways, but it's all good. So you got to understand taking the good with the bad. All right. Hope this makes sense. Let's get into stock selection. So that's where I want to spend some time with you. I want quality stocks. Okay, when I do leaps, these are again, I want you to tune out the whole income poor man covered call thing and just focus on leaps and maybe poor man covered calls. All right, I like large cap, mega cap stocks that are market leaders. I like earnings and revenue growth greater than 10% year over year for at least 2 to 3 years. Okay, so I like strong growers. Now, if you remember with the screener that I have, when we screen for income poor man covered calls, well, I'm looking for 20% growth, earnings and revenue. But with standard leaps or poor man's covered calls, Okay. I'm looking for 10% growth. I'm not looking for quite the same growth rate. Still good, but not quite the same. I am still looking for about 15% return on equity. And then I like liquid options change where I have less than, maybe $1 or 50 cents for deep in the money strikes most of the time. Okay. All depends on the underlying that you have. But typically, I'm looking for something probably less than $1. I know it says 50 cents, but really $1 is probably key for deep in the money strikes. Depends on the size of the asset, right? And then index ETX with positive drift. Okay, that would be another one. I like SPY and QQQ because they just drift higher over time, and I don't have to do all this fundamental gobbledygook here. I just want to keep adding SPY and QQQ. All right, question. Why is it a higher growth rate for the income forming chemical? Because I'm looking for something there with a lot more volatility because I'm only looking for extrinsic. So in order to get the extrinsic weekly, okay, I want something with a little more volatility to it. Okay, so those high growth companies are going to have a lot more volatility built in to their options pricing, which is great if I'm selling at the money covered calls. Okay. But for leaps, I want more stable growers. Okay. So I want maybe a little less growth here. This is like retirement stuff for me. Okay. These are things that I want to own them for years. I don't want to just make income. I want to own the leap that just goes up over time. If SPY goes up, let's say, what is it, 10, 11% a year is the average. It's been more lately, but let's say SPY goes up 10% a year. Well, that's great. So if you only bought the leaps on SPY, you'd be going up 3%, or you'd be going up 30% every year. Right? So income poor man covered call, it's all about having a little bit more juice in the volatility there because I'm getting more volatile stocks, okay, that are faster growers that are going to pay me a little bit more. With leaps, I just want steady growers, okay? And again, if you look at SPY and you go up 10% every year, but I can buy the leaps at a third the cost, which I just showed you up here. I could buy the leaps for a third, actually almost a quarter of the cost. If we go up 10% in SPY, I'm going to go up 37%. Why would you need to do anything else? Okay. This is where I like to put um, some of my investing money. All right. All right. Let's go to how do we select some of these stocks? Let's go back to our trading view. And now we're going to look, instead of looking at charts, we're going to look at stocks. And we're going to look at my LEAPS screen. Okay. Very similar to the income poor man covered call screen, except with the income poor man covered call, I want that 20% earnings and revenue growth. With the standard leaps, okay, the big difference here is I'm looking for 10% earnings and revenue, still 15% return on equity, still high big market cap stocks, and I also want RSIs under 50. I probably would even, let's just say 40 and below, just to see what comes up right now. And if any of these resonate with you, they could potentially be opportunities because these are even more beaten down. Amazon being one of them. Right? So if we take a look at Amazon, okay, well, you're at 39.65 on the RSI. So that's even lower than most of those other ones that we saw here. I'm going to go back to the 50. I don't know why they don't give me 50 as a default setting, but we'll keep it at 50. Right? So it gives me a lot more choices. Don't know that I love any of these more than that, but Netflix does pop up on here. Okay, so Netflix popped up. Okay, there's one. So Netflix pops up, and what is the RSI? Does it even have that? I don't know. at 47.56. Right. So I think Amazon right now gives you one of the best chances if you like the company. It's a steady grower, got great, revenue, earnings. It's all the way down to the 100. It's not far from its 200. I'm not saying this is generational buying opportunities because if you look at the chart, it's still up pretty decently, but I think it's a decent buying opportunity, and I would potentially be looking to scale in on Amazon here. Okay. Also, Netflix, okay, which is at 47.39 on the RSI, is below all of its moving averages, including the 100. Okay. The 200 is nowhere even in the picture here, but here's Netflix, almost to the bottom of the Bollinger Band, below those moving averages. This is not, it's still in an overall uptrend. Now, is it the greatest uptrend? No. Okay. But if you look at the weekly, does that look like a pretty good uptrend over time? Okay. Still in a really good long-term uptrend. Uh, and then just a big consolidation area here, a bit of a ascending triangle too. I think Netflix is not a bad opportunity. Okay. You could look at other ones. Meta is another one. So Meta, was that on here earlier? Or did it just happen to pop in? Meta's at 48.74, so that may have been just today. But Meta, we talked about it earlier. It's down to its 50 almost today. Okay. Obviously, great grower when you look at this thing over time and pulling back to a pretty good area here near its 50. Okay. Is it generational? No, but it's an area where I'd consider it now. Okay. So there's a couple of these things anyway. I just wanted to go through some of the screeners on here, and then I don't love a lot of these down here. And typically, if I'm doing this, I'm doing it for you here today. But normally, I would look at my watch list. Okay. And I only want to look at my watch list because not that my watch list is the end all be all, but I don't want to trade anything that's not in my watch list. Okay. So this just makes it really simple for me to look quickly that, hey, I got Microsoft, Amazon, Meta, Netflix, Shopify, shop. Okay. Pretty good pullback today. Now, is it done going down? Maybe not. So, you don't have to rush into it today. But Shopify is on there. Coinbase is another one with things getting beat up a bit. So on Coin, okay, down here, right around the 100-day moving average, this thing's been really consolidating, and this is a pretty good support level in here. Doesn't mean it won't, that it'll hold or whatever. But Coinbase is it's not a bad spot if you like it. Do you like the story? Do you like the setup? Well, these all fall into my screeners today. So these are all, to me, potential leaps. Okay. If it's not on this chart, I'm not interested. Okay. They're all potentials. Doesn't mean do them. Okay. But we've identified at least 6 potential companies today that could still have more downside. So you don't know that you have to rush in. Uh, Uber's not on that list here, but I do like Uber as an opportunity. All right, let's get off of that and let's get back into our trading plan here. All right. So let's get into it. So, Lewis, you want to take a look at Amazon? We'll use that as our example, but let's go back to our training. All right. So stock selection. Okay. We figured it out. Okay. Now SPY and QQQ, they're not there yet. Okay. Those would be ones I'd really like to get into, and we just have not had any opportunities at all on SPY and QQQ. However, we're not far if we get any more pullback. I mean, today is a pretty good reversal day, so I don't know if the selling is over or not. It could be. Let's get into the trade setup, right? So the trade setup for me is I'm looking for a consistent upward trend. Well, all of those stocks fit that. Market context. I like to enter during broad market pullbacks where we're down 5 to 10% from our highs. Well, we are not down 5 to 10% from our highs. It doesn't mean we can't enter here, okay? But right now we are only off, well, we're down 8% from the all-time highs now. 8% is a pretty hefty drop in SPY in like 3 days. Okay, so oh, I'm sorry, we're down 1.2%. I'm looking at the wrong thing. So we're down 1.2%. If we were going to go down 5 to 10% or so in the market, and again, I'm not saying that this is the hard and fast rule. I'm just giving you some rules. We would have to probably get down to at 5%. We are somewhere right around 633 on it from 658. So we got about 25 points to go, and we're only down $2 today. So we have a long way to go to get there on SPY, but I would like to see, um, ideally, and I'll put it here, ideally enter during broad market pullbacks, and that's your best opportunities. Okay. Technical signals, stock price pullback to its 50-day or even the 100 or 200-day moving average. Okay. Uh, and then I would like to see the 8 crossing back above the 21 once it comes down and tags these, but it doesn't have to. It's just ideal. I like the RSI between 30 and 50. I mean, it could be lower than 30, but I like the RSI down below 50. Okay. Uh, on it. In fact, let's just change this now. Let's just say below 50 and make it easy on everybody. Okay. I just like it below 50. Now, if it's below like 30, that's generational. Okay. That's where you could potentially roll up the truck on these quality names. Okay. If we're below 50, it's getting interesting. If we're below 40, I'm really interested. If we're at 30, I'm massively interested in any of these names. Okay. Rising up or down, doesn't really matter to me. Obviously, if it's heading down, you got to take a look at everything in context uh, there. So we could still be heading lower, and you may not want to catch the falling knife. Okay, but I think uh, that's an opportunity, right? Yeah, and this might not be the pullback here. So, Nicholas, 630s would be nice, but we have not been below 50 EMA since May. Right, and we may not get there. So we might not get our chance for a while yet, right? Which is why you got to play the patient game and why you have to be smart, okay, when you get the opportunities to jump into some of these things. So that being said, uh, you'll get opportunities. You just have to wait for them. All right, and then bullish reversals off the lows or MAs. Okay, if we can get a bullish reversal. These again giving different technical signals here. Bollinger Bands. I like to buy it when the stock's price is near the lower Bollinger Band. Okay. Well, we're nowhere near that on SPY. Okay, so that's not an option right now. Amazon, we are absolutely at the bottom of the Bollinger Band. Okay, so RSI is below 50. It's below 40 right now in Amazon. Okay, so Amazon's looking better and better, right? Uh, you've got a pullback below the 50 to the 100, almost the 200 day on Amazon. You've got an RSI below 50, actually below 40 right now. You've got a Bollinger Band touch today. Well, it's been actually for 3 days now. It's been riding the Bollinger Band lower. And then MACD, I'm looking for the MACD to cross maybe above the signal line. So we're not there yet. So the setup is there. Okay. But I'd like to see the reversal start. I don't have to be first to catch the falling knife. Okay, someone else can catch the knife. I'm just going to step on the dead body and buy in. I might be a little bit late. Okay, but that's it. I'm not showing my chart, Lewis. So I'm just talking about it here. Oh, we already covered Amazon. And then volatility. If we get an IV rank, I prefer IV to be a little bit lower as well, because Why do I want to pay all of that? Now, IV rank on Amazon is at 26, 25.8 right now. So it fits that as well. It's preferred, okay? Because I'm just paying less. I don't want to buy something that has an IVR of um, Bridget. All right, yeah. So yeah, I don't want to. I don't want to. I almost said I don't want to step on the dead body. I don't want to buy something at a 90 or an 80 or a 70 IV. Okay. And I'm not a big volatility guy, and you guys all know that. I don't believe a whole lot in trading high IV and IVR and holding off and changing your portfolio allocation based on it. I don't trade VIX or VXX. I don't do any of that stuff. Okay. Volatility is just not super important for me. All right, let's get into the trade entry. All right, so we want to look for an expiration that's 9 to 16 months out or so. And we want a strike price that's going to be in the money. And I think Delta 75 to 85 is a good place to put those leaps. Again, we're going to ignore the synthetic stock option opportunities for today and just focus on deep in the money because there's benefits to both. Uh, 75 is fine. 70 is not terrible if you don't have a lot of funds. Okay. 70 Delta still gives you 70% of the action and a lot lower cost. So you do have to play it a little bit right now. If I was looking at 1 year out on Amazon, well, the 70 Delta is cost me $50 and the 80 Delta cost me $70. Okay. Is it worth it? Okay. That's $20. Okay. It's going to cost me 40% more to buy the 80 Delta than the 70. So 75 may not be a bad spot. 80 is a pretty typical strike. I think it gives you the best of both worlds, but I don't think 75 is all that bad. All right. So that's what we're going to look for is something in that lane range. Um, the leap should cost me about 25 to 40% of the stock price. Well, right now Amazon costs 220, and if I bought the 80, it would cost me 69. So 69 divided by the 220 is 30%. So Amazon's 80 delta is at 31% of the stock price. So that's pretty good. And BidX spreads, again, 50 cents. Yeah, we're close. We're less than a buck. We're actually at 50 cents. Okay. It's 69.85 and 69.35, so that's 50 cents. So we do have really good liquidity down here. Right? Now, ideally, too, I don't want to risk more than 5 to 10% of my portfolio. I don't even want to risk more than 5%. So let's change it. I don't really want 5% of my portfolio in any single position. SPY and QQQ might be an exception, okay? But they're broad ETFs. If I'm definitely doing stocks, I really don't want anything that big. Okay. And I put 40 to 50% here, but I think this is too much. I think 30% of your portfolio in leaps. Now, if you're going to do leaps and just buy them and use them as a core strategy, but you're also going to do permanent covered calls, well, you're doubling your exposure. I'm okay with that um, a little bit here. We don't want to get too crazy with too many leaps, uh, even if there's different purposes for them. All right, so I did adjust some of these notes. All right, so that being said, we could go into our account now, and we're going to look at Amazon, and we would go out a year, so we're at the 358. It fits most of our criteria. So if I was doing Amazon today, I would look at probably this 165, 170. Either one, it doesn't really matter for purposes here, but I could buy the 165. Okay, so this thing's going to cost me 6,900 bucks from a cash standpoint. Okay, from a margin standpoint, it's only going to cost me about 2,900 with portfolio margin. Okay, but let's let's not worry about that necessarily right now. Let's just look at the actual cost of $6,900, right? So you own $6,900 is all it takes for you to get 100 shares of Amazon. If Amazon goes up $1, okay, that means we're going to go up 80 cents on $69 here. So we'll make like a little bit over 1%. Okay. If Amazon went up $1 on the stock at 220, you wouldn't even make a half a percent. Okay. So we're actually doubling. Okay. We're actually doubling our returns in Amazon. Okay. Pretty nice. Now, if Amazon falls 10%, okay, you're going to lose 20% on this trade. If Amazon goes up 10%, we're going to make, 10% on this trade. So if Amazon goes up at $220, if Amazon goes up 10%, okay, that's $22. Okay. So if Amazon goes up $22, that's a 10% gain in the stock, right? Okay. But at $22 times 0.8, because it's 80 delta, that's 17.6 divided by 69.05 if you want. Okay, that's 25%. Okay, so if Amazon goes up 10% from here, you will make 25% on this move. Okay, that's not bad. Okay, 25%, which is why the power of leaps is fantastic as long as it's going your way. And I'm just not buying leaps that don't fit stocks I like. I'm not buying it on crazy stuff out there. Okay. I want solid growers. Okay. We already talked on the stock screener that right now I'm looking at Microsoft, Amazon, Meta, Netflix, Shopify, and Coinbase, and even Shop. And even Shop is not my thing. I like Reddit as a trade. Okay, so the question, Nicholas, do you like Reddit? Well, yeah, I mean, I do like Reddit as a trade. I'm not doing it for this because it doesn't meet my criteria, but I do like Reddit, and I'd consider, it for certain types of trades. Certainly, if I wanted to, put on some sort of a swing trade or something here on this move, this is not a bad spot, in my opinion, to potentially sell like a naked put on Reddit. Right? I'd consider I consider it. Um, yeah, you could do anytime I say naked put, you could substitute put credit spread, depending on your account. Certainly. Okay. So naked put from is what I would prefer, but for my smaller accounts or IRAs, then I would potentially do put credit spreads. All right. Um, I'm not sure what you're saying here. Can you change this Amazon trade from in the money call to in the money put at 275 for a credit trade? If you want to, you can. Right? So if you would prefer, um, oops. So if you'd prefer to sell the leaps in it, I'm fine with that too. I like that. I like that very much. Okay. But here's the key, right? You're going to generate, you know, right, if I want to do this, okay, I'm going to generate $6, okay, on very little margin for me. But let's just use the $16,000. If you're selling the 16.5, okay, if you subtract your 615 bucks here, okay, you can make $615 on 16,000, right? Which is 4%. That's not bad. Okay, but 4% over the life of this thing is not great. It's not bad. Okay. And if you really think about your buying power, okay, it's phenomenal. It's a double. Okay. So you could do that. But that being said, I could, with the leap, I could double my money quickly. I mean, I could easily see on a 10% move, you'll get some decay on that leap, but not a ton. Okay. But on a 10% move, I'm going to make 25%. It's just going to be exponentially better. But you could sell uh, that. Oh, wait, I'm not really sure. Oh, you want to sell in the money. Okay. I wouldn't, that's not my thing. I would, no. Um, yeah, okay. You said you want to sell, I'm sorry, if you want to sell in the money, put it 275. No, no, not me. I do not do that. Um, doesn't mean you can't. That's just not a me thing. I don't sell in the money puts. That's just not a thing for me. Right. All right. Don't like that trade. Don't like to be in the money on puts. Um, but pretty much the same thing. But yeah, you're looking at the K. You just work it out the same way. You're going to get the decay, okay, but you're not going to get the exponential growth. There's a big difference between theta decay and growth of a leap that's exponentially rising. Okay. And that's the difference. Okay. The difference here is you've got a certain percentage that you're going to make and slow decay. But if Amazon moves again 10%, you're going to get some decay. That'll be great. Okay. If it moves $22 on a leap, you might get a little bit of decay. I'm going to make 25% on it. You're going to make 3%, something like that. All right, so just keep that in mind because you've got a year to wait, and you've got uh, when you're selling the in the money. I'm sorry, here. Let me delete these things. I'm not showing the screen, but you're going to have theta of like a 184 bucks a day. Okay, and if we move 20%, I'd have to look to see what uh, the move would be. You know, I don't know if I can do that. Hang on. No, I'm not gonna bother. But yes, you'll decay, but a 20% move in Amazon is not going to give you a 25% gain on a leap. It's very slow theta. Okay. And we have to look at the gamma on that, which is also very, very low. So it's not going to move much. Okay. I'm buying a call. Right. So I'm buying the call. I'm not selling a call in the money. No, I was buying a call. Okay. All right. Now let's keep moving. I don't know what you guys are talking about. All right. So trade entry, I just showed it to you on Amazon. If I'm doing the leaps here, okay, I'm buying the 165. Okay. On this, going to cost me about 69 bucks, something like that. Right. And we'll do it. All right. But you because of the leverage and the fact that you're getting 3 to 4x the leverage, this is where leaps pay off in your account. Okay, and pay off quickly. So let's go into trade management here. Partial profit. Okay? You could take 50% off if the leap goes up 100%. So if the leap goes up 100% and it doesn't take much to go up 100%. Okay, on it. We just saw, on Amazon, if it went up, uh, well, if it goes up 10%, we're going to make 25. So if Amazon goes up like 40%, which is like 80 bucks, we'll make 100% um, pretty quickly. So if Amazon's up 40%, we're making 100% on the stock. At that point, I would be taking probably half of it off. And then if it continues to go, I'll take the rest off at 150 to 200% gains. Capital rotation here. The nice thing about taking it off is I can move profits into new leaps and add better risk reward. I can also exit early. If I get a bump 10 to 20% or in 4 weeks, I'm up 20 to 40%, I might consider taking it off early. So again, you can use it for a trade. All right, so you can use it for a trade here. You can get those moves because, like I said, it only took a 10% move in Amazon, okay, to pop us 25%. So even a 5% move in Amazon, which would be $10. Okay, if Amazon goes up $10, which it could probably do tomorrow if it wanted to. Okay, if it goes up just $5 tomorrow or 5%, whatever, which is $10. If it goes up 5%, we're going to make like 15% in a couple days. Okay, that might be enough to just exit the trade there, depending on how much you had on. All right, really quickly here too, stop losses. Okay, I'm going to look. Okay, I'm not setting a stop, but I will look. I keep a mental stop that if the stock closes below key supports like the 200-day moving average, I'll probably look to potentially close. Or if the leap loses 50% of its value, okay, or if the thesis changes. You'll remember that on the Pullman covered call, I typically look at like 30%, okay, but that 30% on a Pullman covered call is the loss on the longs minus any gains on the covered calls. If that hits 30%, I'm typically going to look to exit, okay? But if I have a leap and I don't have any calls on it, if it loses 50% of its value here, I might be out, right? Or if there's anything, the company's earnings guidance deteriorates substantially, I mean, I'll just get out. If my thesis completely changes, um, then I'll get out. All right, and then lastly here, some rolling rules. When do you roll? If the stock rallies like 20 to 30% quickly, okay, I might consider selling the current leap and then buying a higher strike leap, which is be rolling it up. Okay. If it rallied 20 to 30% quickly, I'd probably readjust. Okay. And if delta exceeds 90 delta, I'd consider rolling that back up to the 80 delta. Again, to lock in gains, it'll reduce my cost. It's going to free up a ton of cash and reestablish the leverage that I have. Because at 90 delta, the leverage is not the same. It's a higher cost. And 90 delta would almost be about a $30 move, which is almost 50% of the cost of the leap. Okay, so if I can recover 50% of the cost of the leap and roll back down to 80, and I still like what's happening here, I reestablish the lower cost base so that every move gives me a higher leverage. Does that make sense? Okay, so if we get to 90 delta and the value is $100 and not 70 anymore, okay, then I'd rather have I'd rather take the money, get back down to the $70 at the 80 leap, okay, and have the better leverage going. Would you roll to the same expiry if it happened quick? Yes. Okay. I would, unless, the next one out or something provides me a really good deal, and it depends how far into the trade. Okay. There's a lot of, it depends. It's hard. I'm giving you a lot of rules, but I can't give you every scenario here. Most likely, if it was a quick move, it'd be the same expiration. If it was a slow move and we get to 90 delta, but it takes me 6 months to get there and there's only 6 months left, and I still like the stock and it's a decent opportunity, then I might consider then rolling out to a further expiration. All right, and then rolling out, if the leap has less than 3 to 4 months left, 90 days, 120 days, then I probably would roll it into another 12-month contract to avoid any accelerated time decay. I don't know. I'm probably closer to the 60 to 90 day on these things, especially if it's been doing well and the delta has moved up. Yes, it's got time decay, but if I'm making a boatload of money, it all depends on how much time decay it has. Now, certainly I'm not going to hold this inside of 60, but I would consider things. All right. All right. So that's pretty much everything on that. A couple quick things is you can income stack using these. We won't go into it because it's a whole nother training, but you can turn it into a poor man's covered call. Okay. But if you're going to do that, again, the poor man's covered call for me is uh, I want to sell out of the money only, not at the money, not in the money, not out of the money only. I think 30 to 45 days on these leaps is probably best. And I like deltas between 15 and 30. And again, if you remember, I use dynamic deltas for my poor man's covered calls depending on the technical analysis. If the eight's above the 21, I'm selling roughly 15 delta to 20 delta, pretty far out of the money. If it's below, then I'm going to go back to around 30 delta, but probably not much below that. Because again, the goal on the leap, okay, and the goal on the poor man covered call is not the income, it's the leveraged growth of the underlying. Okay. So you definitely don't want you just want a little bit of cash to reduce your cost basis, but you don't want to make that the primary tool. The income poor man covered call, that's its job. Okay. And then roller close early here. Um, on it if it reaches 70 80% max profit on the covered calls, pretty much the same covered call thing. And then compounding gains, this is how you grow wealth. Here is reinvest the profit. So as you take these gains from leaps, which can be like in this year where you've run up substantially off the lows, if you got in at the lows, I mean you have 120, 150% gains on some of these stocks that we got in. All right. I'm up on like Hood. I think that's up something stupid. I don't even remember. Let me see if I can even find Hood, but um, on it. But on my Hood, I'm up almost 300% on Hood for the year. Okay. Hood's up 180% since we got into it, but I'm up like 300%. On Hood. Okay. So again, the ideal here is you take part of that off, you readjust. Okay. You book the gains, you take the cash. Okay. And then you can buy back into Hood and I can buy back into something else. So now I have two stocks. Okay. That are quality, or I could buy some SPY or some QQQ, and then keep diversifying your winners. So spread into multiple high quality names on there. So I want as many good quality, or again, I think you could just plow it into SPY QQQ uh, on that. All right, and an initial entry piece too is if you're looking to do this, start small. Okay, let's say you have $100,000 account and you're going to devote $10,000 to leaps or something like that, or even $20,000 or $30,000 to leaps. All right. All right. Let's say we're going to use $30,000 to put into leaps of our $100,000 account. We're going to use 30,000 for it. Okay, great. Maybe that's three or four positions, okay, that we talked about. So I'll take three or four positions, which means I'm probably going to look at about 10 grand per position. Okay. I'll probably start with like 5 grand on a leap, and then I will scale in if I get better opportunities down the road. If I don't, it's okay. All right. All right. So was this helpful? Makes sense. I think we're right about an hour on here today. So we'll post this in there. But that's really how I'm viewing leaps. We're getting better setups on some stocks. We are not getting the setups that I want on SPY and QQQ. Okay. And what am I doing about that? And the same thing I've been telling you is I will look at essentially a wheel type of a strategy to get me into that leap, which means what did I say on SPY? Um, where did I want that to get to? Was it 630 or something along those lines? So let's say I want to get in around 630s. All right, 643. 640 is the Bollinger Band. 643 is the 50-day moving average. So that's fine. So maybe on SPY, what I want to look at here, and I've been doing this um, all along, is I will take a look at a 30-day strike. I'm not really, I can show it to you if you want. Yeah. I can look at a 30 days out expiration, and I'm going to go down to that 630, 640 range, whatever. My 643 was the one. So let's just do in the middle, 635. Okay. I can sell this right now. Okay. And if we drop down and I get assigned at 635, okay. Oh, I still have something else on. So hang on, get rid of that. Okay. So here I'm going to make 363 bucks, which is not a lot of money, but I don't have a lot of buying power into this thing, so it's all good. Okay, if I wanted to buy one contract, or if you want to buy maybe two contracts of SPY, but whatever sizing you wanted. Okay, if you were going to buy two contracts of SPY at the 80 delta, all right, what did we say it was? I think I'm sorry, I'm back into this thing. I think we said it's about $69, I think. Oh, that was Amazon. So let's take a quick look at SPY. All right, if we wanted to buy the 80 delta here, it costs us $15,000. Okay, so depending on the size account, for me, a $15,000 cash purchase on this, okay. So if that's just one contract. So now I go uh, down here, I'm selling my one contract. Okay. All right. So I'll make maybe 400 bucks on this. So I get paid to wait. Okay. I'll make my uh, essentially 5%, right? So 367 divided by my 7057 margin, 5%. So I get paid 5% a month to wait for my option. Okay. And again, selling is great, and I love selling. I'm a big premium selling person. Okay, that's how I prefer to trade, and I love selling covered calls. Okay, so those are two of my favorite things is, selling naked puts, selling 112s, okay, selling covered calls. Okay, those are my favorite things to do. Selling strangles, same type of thing. Right? But in an investing account, I want the leverage to grow my account over time, hence the leaps. So this is how I look at it is, okay, I'll sell this for 400 bucks almost, right? In fact, we can just go to 400. Now I can make 400 bucks on this and make, 5, 6% over the next 30 days. And then you know what? If we get assigned on it, then I'll immediately flip that thing because I get to keep my 400 bucks. I'll get assigned at the strike that I wanted to. I can sell my 80 delta and now I'm in the stock. So this is how I think you get paid to wait. Okay. And I think when people look at, uh, the wheel strategy, I mean, when they say sell, sell it on only something you want to own. Well, I don't think anyone really wants to own most of those stocks. Okay. But this is where I actually do want to own SPY and QQQ at a discount. Okay. So I want the discount. I'll get paid to wait. And if I get assigned, I'll be in great shape. Right. So what happens when I get assigned? When you get assigned, I'm going to get assigned at that 637 strike. I'm going to own 100 shares at 637. Okay. Right? So if you don't have $63,000 in cash, it's not a great strategy. Okay. For you. For me, it's okay. I can hold it for a day. I will then turn around and I will sell it. Okay. I might lose, have some slippage uh, here or there, all depends. Uh, but I'm okay because I took in some money to wait. But more than anything, if you keep doing that and you get paid to wait and you finally get in at the stock price you like. If it blows way below it and you get assigned, well, that's not going to be great because then I'm going to own it at 637 and maybe it's down to 630. I'll be losing $7. I'll be losing 700, but I got paid 400 to wait. Okay, so I'll only be down 300 and I'm able to get in the leap where I want to. And again, assuming that I can get 3x leverage, okay, and we go back up 10% over the next year after that 20% down move that we just factored in, or 10% down move. Uh, if we go back up 10%, I'm going to make 30% on the leap. Okay. So would you spend the $300 loss, even if it went $7 below, or if you just got assigned? Okay. Would you spend a couple $100 on that to get assigned to own something that could then give you a 30% gain if the market goes up 10%, which is very likely, and I'm going to make a bunch of money because a 30% gain would be a pretty nice opportunity. All right. So when assigned, you're going to get assigned stock. So then sell stock and then buy the leap. Yes, that's what I'm saying. Okay. I don't like to own stocks. Okay. If you do, fine. If you got portfolio margin and you want to own SPY, there's nothing wrong with it. Owning SPY is not a problem. I don't know that I want to own, Amazon and Tesla and all these other stocks, even though you like them. Okay. And I'll give you the quote that I've used forever. But he who dies with the most SPY wins. Okay. Write that down. He who dies with the most SPY wins. Okay. Or QQQ, but QQQ doesn't sound as cool. All right. But I think if you own those, I think you'll be in great shape. All right. That's it. Do I hedge my leap call? No. There's no reason to hedge a leap call because it's already defined risk because you own it. The only thing I hedge is sometimes if I buy the synthetic call and put, then I may buy a protective put on that, which is going to give you almost the same setup as the leap because it's going to give you basically the same loss, max loss. You can't go below that. However, it's cheaper than the leap, even with the protective put. So there you go. Hope this was helpful. We'll see you guys later. Enjoy a great rest of your day, everybody. See ya.